Hey guys, this is Harsha and welcome to Easy Money. So in this session, we'll look a little more into option buying. So I had earlier one video about the break-in even point when you buy an option, either if it's a call or either it's a put. And here we will be discussing another strategy where involves option buying only, but with a little more less risk, but to manage better so that you don't have that much of a loss. So I'm not really a big fan of option buying, but for some people, right, either the margin money that is required for option selling is not available, or they don't want to take this much risk also through option selling. So option buying, if is really your the way that you want to trade, then there are a couple of things that you could do. One is when you buy an option, right, and the best way that you could do is if you're really alert and you actually track the market continuously over the market hours, then it's possible that you actually catch up on a momentum or a swing, and then it's possible that you actually take either the call or the put in that direction and still make some money. So my preference then would be that you enter and exit the trade as soon as possible and take the profit as when it is possible. But if you want to go ahead and actually go ahead with a strategy which you can hold until the expiry date, right, then we can think of something called a spread. Okay, so let's just go into a little more details. So currently, Nifty is trading at 15,763. Okay, so let's just scroll down and let's look at the call prices, right? So this is for the fifth expiry, and today is Saturday, and so there's still 4 more trading days for the expiry. Okay, so let's look at the values. So 15,700, 15,750, right? So this is just in the money, and 15,800 is at the money. Okay, so we have discussed also in the previous videos, right, about what is the intrinsic and extrinsic values. So every option price, right, has some kind of a component which is actually intrinsic in nature, because this means that okay, the Nifty has actually crossed that point and there is some value attached to it. And then there is the extrinsic value, which is purely the time value, and this is really you bet that okay, that the market will actually go in future in the direction that you propose, and also significantly higher base in a quick time so that you can actually make some money, right? So 15,700 is 120, right? It's around 120, and since the market is at 15,760, let's assume it is at 760 instead of 763. So you know that 60 points is the uh, intrinsic value, okay, and 60 points is the time value, okay, and that's also pretty high also because because there's still 4 more days to the expiry. At the same time, if you look at 15,800, the market has not even reached this place, but still the call option is trading at 62 rupees, right? So this is purely, there's no intrinsic value because the market did not reach 15,800, and this is purely time value. Okay, so now here also we saw there is a 60 rupees of time value, and here also we have 60 rupees of time value. And if you really wanted to do something, right? So what we could do is one option, so that yeah, so maybe I'll explain it. So let's take this position 15,700. Okay, let's buy this call. Okay, and let's observe here what happens. So when you take the 15,700 call and you are paying 120 rupees, right? And the lot size now is 50, 50 into 120. Maximum loss is 6,000, and the maximum loss will happen if the market closes below 15,700, right? But if it closes anywhere 710, 720, 30 or anything, you can still get some value out of it as long as it is above 15,700, right? So now the break even, if you see, to just recover the the loss of buying the call itself, and if you hold it till the expiry, right, is 15,820, 700 plus the amount that you have paid. So if you really hold it till until expiry, then the market should close above 15,820 for you to make any money. Okay, so many people, right, will think option buying is a quick way to make money, and that you can get exponential rewards, which is also true. And yes, there is infinite profitability, also true. But the likelihood that this actually happens is very slim, and not that over a period of time, right? It's not so easy to actually consistently make profits just by buying. But there are some skilled people who can do that, but that requires time and dedication, and right. So here, so 15,820, right? And the margin money is only 6,000 rupees. That means if you, in your account, if you have 6,000 rupees, you can go ahead and take this position. But making it profitable is a challenge by itself. Now, what we could actually do here, right? So we saw that this has some kind of intrinsic value of 60, right? And you have a feeling that actually market will go up, and you're assuming that, okay, by expiry, at least, the value will be a lot more. At least it'll be more than today. Let's assume, right? 15 instead of 15,760, which is today, maybe you expect at least another few points more, and it'll at least not go down. So what we can do now is to protect this position and to decrease the max loss as well as to decrease the break even, right? Because here until 15,820, we will not be actually making money if you hold it till expiry, right? And what we have to do is we have to give away some of these profits. So there is no infinite and exponent, right? Not exponent, but I will say large profits. Yeah, you will assume that, okay, do you think, okay, within 4 days market will go to 16,600? Maybe not, right? But we will limit the profit capabilities, and by limiting the profit capability, we will reduce both the maximum loss and the break even as well. So what we could do is, let's choose um, you know, uh, a call which has a only purely the extrinsic time value. Okay, so we know that 15,800, right? If 15,800, there is absolutely no intrinsic value. It's just purely time value, right? So what I will do is, against the option that I have bought, which is the 15,700, let's go and sell the 15,800. Okay, so this, though you are actually selling, right? The risk here is it's not like you are protected by the call that you have bought, and so this is, we will not say this is actually kind of a naked selling or anything, but you are protected by the call that you have bought, and because the call is on the 700, the lower side, and the one that you're selling is on the higher side, so we'll see that this is actually not going to add a lot into your margins also. Okay, so what we have done, so we bought the 15,700. So this had 60 plus 60, right? 60 intrinsic, 60 extrinsic. And here we sold the 15,800 purely extrinsic value, which is kind of this one. Now just look at this. So what we did, right? So now we cut the maximum profit, right? So the maximum profit can no longer be, there's not this big graph which goes vertically high, but we cut the profit, and the maximum profit now possible is only 2,100. But look at the maximum loss. The maximum loss is also reduced by half. It was 6,000, which was the maximum loss, and now the maximum loss is much lesser, right? It's half of it, right? So, and look at the break even. So instead of 15,820, right, you will not make any loss if the market closes above 15,758. And in fact, if you see, the market is already 15,760 somewhere, right? 763. Now, as long as the market is either at this position or just continues to move a little bit higher, and or right, there is no chance that you will actually make a loss, a big loss, but right, there is some possibility of making a profit. So what we have done, we cut the profit. Okay, by cutting the maximum profit, what we have done is we have reduced the loss, and we have also reduced the break even. So this is one thing. But now, if you're a little more bullish, and you are still want to take a little you think that okay, there is more profit potential and you think market will close at say 15,900, what we could do is instead of selling the 15,800, you can go ahead and sell it say 15,850. So there your loss is now still less than 6,000, right? So it is around 4,000 now, and your profit has slightly increased to 3,500, and your break even has increased to 15,780. Now we will just say 15,900 here. So here you think that market will expire just above 15,900, then it'll be perfect. So if this works in your favor, then the maximum profit is also higher, but the maximum loss also has increased, and the break even also has increased. Okay, so instead of just buying an option, right, which will take which will take the maximum premium, what you could do is you can also think of you know selling one higher option on the same side so that you can cut the profit part and then reduce your break even and also reduce your maximum loss. Okay, so it's see there's also other strategy that you can decide that since market is at 15,700 and here it is 120 rupees, you can also say that okay, I will move this guy and instead of buying the 15,700, I will buy the 15,800, which is still, I mean, the market has not yet reached there. So what you can see is the maximum loss has reduced, right? Because now we are just 800, 900, and the price of the 800 is much lesser, which is a 62. And then we have one position which we have also sold. So the profit is much more, which is still 3,000, but loss is also reduced, right? But what happens is the break even has changed, right? Now for you to be correct and to actually start making some money, the market has to close above 15,837. So this is one simple strategy. So I'll say that instead of purely buying a call and holding till expiry, it might be better that you actually buy a call and then sell a higher level call against it. The same option can also be done on the put side. It's just that on the put side, you will, if you buy the 15,800 put, right, you will sell the, for example, on the put side, right? So put side is in this direction. So if you buy the 15,800 put at 97, you will be selling something lower. Okay. Okay, so then the gap between these two, you have the profit potential there, and you can reduce the price of the call itself which you have bought. Okay, so but see, this is taking a margin of 15,000 only, and this is still because the risk involved is still not much. Okay, there is only one to one position, so you are protected 15,800, and 15 is protecting you, and 15,900 sell is also fine. So now with this, you can actually manage better. I would say instead of purely just buying a call, if you plan to hold it till expiry, then you can use this strategy. Okay. So that's all I had for this video. Thank you so much.